I think this economy is cooking. Take a look at this ISM report. Jobless claims, wow, a rebound in productivity.
I see evidence that productivity is starting to make a comeback.
Bonds are oversold. Yields are overbought.
If this is a bull market, what's a bear market look like? Rallies from here are sell-up events. Use them to sell strength.
So rates are just going to continue to shoot higher.
Everything you throw at this, there's more sellers than buyers. I think it reflects the massive amount of supply that's out there. I would look for is when the flows into the bond products stop. It just seems so inconsistent to look for a high in yield when everyone's still chasing bonds. And I think the irony is many in this business waited their whole career for bond yields to start going up. And now that they've started going up, everyone's so eager to buy them.
What do stocks do if we get to 5?
If this is a bull market, what's a bear market look like? Because there's a lot of bad charts out there. The big weights have kind of kept the indices above the fold here. But when you go kind of name by name, only 40% of the S&P is above the 200. We're probably tactically oversold. But that's not the big story to me. The big story is we're very weak from a foundational perspective under this market. I think rallies from here are sell-up events. Use them to sell strength. If soft landing's the right call, discretionary should turn up meaningfully here, and it should be broad. So the fact it hasn't, I think, raises some questions there.
Energy is the top holding.
Yeah.
Why?
95% of them are above the 200. Everything we've thrown at them for the last 2.5 or 3 years, they've brushed off. It took 6 months off, and everyone forgot about it. I love the paradox of the percent CPI print on July 12th of this year re-engage this group. I think it's a consolidation. I'd be a buyer of weakness in energy.
Good seeing you. Thanks for being here. Yeah.
Thank you.
Chris Verone, strategist, joining us here at Post 9. The bull case for stocks, Ed Yardeni.
The bond yield was trading around 4.5%, 5% in 2003, 2004, 2005, and 2006. So I think we're back to normal. We've normalized the bond yield in the past 3 years, and the economy has withstood it remarkably well. So I'm not convinced that the economy, I think the economy itself is showing that it's resilient. I'm not convinced that these rates are going to crush the economy. I've been arguing that the economy is in a recession. I've been making that argument since the beginning of last year. I've been calling it a rolling recession. The surge in mortgage rate certainly has created a recession in the housing market. It was a recession in the single-family housing market. Now that actually looks like it's bottoming as the multifamily housing market's taken a dive because rent inflation has come down a lot, which is great for the inflation outlook. These rates are going to kill a lot of projects in the commercial real estate market. Now they have to refinance them. The math just doesn't work. The net worth of the household sector is up to $150 trillion, all-time $155 trillion, all-time record high. Half of that is held by baby boomers. Many of them are retiring, and guess what they're going to do? They're going to spend that. So talk about excess savings. The baby boomers have saved for retirement, and they have a lot of money to spend. Analysts have recently been actually raising their estimates. Looks like the profit margin has turned. Looks like things are actually getting better. I can't dismiss the possibility there'll be a negative quarter in the fourth quarter if the auto strike lasts through the end of the year. But I'm expecting that there will be a settlement. But going into next year, I think next year will be a growth year. I think the consumer will continue to have employment gains. I think real wages will be increasing. The big secret sauce in this whole thing is going to turn out to be productivity. I see evidence that productivity is starting to make a comeback.
How are you feeling about yields? Toppy now?
From a technical perspective, yields are overbought or bonds are oversold. We've seen this move be near parabolic, which means that you could see some digestion that could provide some relief in this fourth quarter. But I think if we're looking at the trend in yields, it still is very resoundingly positive to the upside. And then if we think about the fundamental dynamics, you still have this scenario where supply is coming in much higher than expected because of higher deficits. And there's just not the demand for that safety trade yet from the market. If you think about demand coming from people worried about a recession, data comes in better than expected, you're not seeing that same kind of flock to safety that could buoy yields. Given where we are in interest rates, it's likely to say that you could see even more come out of the valuations, mostly in those growthy side of things, if you start to see a shift to more risk-off type of positioning and that risk aversion come back to the market.
I think this economy is cooking. Take a look at this ISM report. Above expectations, estimates of third quarter GDP are north of 3.5%. GDP now are even north of 4%. We have a strong economy. And of course, the rising oil prices, which is really a supply shock because OPEC is, I think, at a record restriction from their capacity. Don't forget, bondholders look at overall inflation. They don't just look at core inflation. Core inflation might be doing good.
Yeah.
Overall inflation is going to be affected by those oil prices. The higher yields, that's what's been pressuring the equity markets.
You can't say that bond yields are rising because the economy is strong, because it's not strengthening.
Third quarter is going to be north of 3.5%. We're going to get positive payrolls again. What's happening is a rebound in productivity. Remember, 2022 is the worst productivity, I think, that we had in 75 years. And what we see is a rebound in productivity. We don't need blowout payroll growth like 250, 300,000. We could have 150,000 and still have GDP growth above what we've had for the last 2-3 years. Look at jobless claims, 200,000. Wow. I mean, that's one of the first indicators to really show weakness on the real side. I don't see it yet.